Welcome to Quant Risk. Value at Risk, commonly called VaR, is a measure used by investors and financial institutions to understand how much money their investment portfolio could potentially lose in a given period, such as a day, a week, or a month. It gives a single number that summarizes risk, making it easier to plan for market uncertainties. Investing always comes with risks. Some days the market goes up. Some days it goes down. VaR helps investors quantify how bad losses could be in normal market conditions. It provides a clear picture so people can make smarter decisions about saving, investing, or hedging. One way to calculate VaR is to look at historical data. We take past portfolio returns and see how often losses exceeded certain levels. By plotting these returns in a histogram, we can highlight the worst 5% of outcomes. This is the VaR region. This helps us understand potential extreme losses based on what has happened before. Sometimes historical data is not enough, especially for complex portfolios. Monte Carlo Simulation generates multiple possible future paths of the portfolio by randomly sampling returns based on statistical models. Each path is drawn in a different color to show the variety of possible outcomes clearly. By observing all these paths together, we can identify the range of potential portfolio values and visualize where extreme losses might occur. This simulation lays the groundwork for marking the VaR threshold and confidence intervals. After running Monte Carlo simulations, we can see the range of possible portfolio outcomes. Each path represents one possible evolution of the portfolio over time and is drawn in different colors. On the right, a histogram shows the distribution of final portfolio values, highlighting how outcomes spread. The 95% confidence interval is highlighted, and the tail beyond this, representing extreme losses, is shaded red as the VaR zone. You can better map return. But in our simplistic example, if you start with a portfolio value of 100, there is a 5% probability that the final value will fall below this VaR threshold. This visualization gives investors an intuitive understanding of both normal fluctuations and rare, extreme losses. VaR also helps us understand which parts of the portfolio contribute most to risk. By comparing different assets, we can see which ones are more volatile or more likely to cause large losses. The assets are plotted, and any part that falls into the VaR zone is highlighted in red. This visualization helps in making decisions about diversification and managing risk efficiently. Regularly calculating VaR allows investors and institutions to monitor risk and prepare for unexpected events. It is widely used by banks, fund managers, and regulators to ensure financial stability. While VaR does not predict every possible loss, it is a powerful tool to understand potential downsides and make informed decisions about managing investments. Please like, share, and subscribe for more updates like this from our channel. And don't forget to press the bell button to stay notified.